At the time that I'm filming this video for the 2024 election forecast, it's about 50-50. Technically, as I'm filming this, Harris has a slight edge, but pretty much 50-50. So I want to get into the nitty-gritty of what this means for the stock market and your investments, and basically I want to talk about what it means for your money. How investors can position their portfolios ahead of the 2024 presidential election. This is a quick breakdown from CNBC, and I think they bring up some valid points because they're able to look at how things historically have played out. There will certainly be winners and losers coming out of this election cycle, depending on what happens with corporate tax rates, what happens with regulation, and what happens with geopolitics. Especially the tax portion is going to have huge implications on what size of business, large cap, mid cap, small cap, is really going to be able to either get hurt or really flourish in the upcoming 4 years. According to experts, small cap stocks could potentially benefit under a second Trump administration, mainly because that's what happened before. When capital is cheaper, it's easier for people who are in need of capital, i.e. small businesses, to do better. If you look at after Trump was elected in November of 2016, small caps in those initial months really performed well, double the performance of the overall S&P 500. During his administration, the performance was right in line to slightly below large caps, but we didn't have this really wide performance disparity that we're seeing now between mega caps and everything else. Now, on the flip side, if you're feeling a bit more confident about Harris, or if Harris just wins and you're trying to play it adeptly, renewable energy is a sector that some analysts predict would benefit under a Harris presidency as she seeks to build on the investments of the Biden administration. The biggest thing about Harris being in power would be protection and continued implementation of the Inflation Reduction Act, which is a key legacy of the Biden administration. A lot of it hasn't been implemented yet, but this is a big for wind and solar, biofuels, and nuclear hydrogen. So those are some subsectors of it all, but I do want to let you know about just some generic trends of really October and the remainder of the year. So I know that a lot of scary things have happened in October, as in flash crashes and absolute pandemonium and chaos. But if you look at every single October, it actually favors the bulls. Yeah, it's a bit choppy, a little bit to the upside, a little bit to the downside. But when you get into the final 2/3 of October, it actually favors the bulls clearly. November very much does, with a little bit of a breather around Thanksgiving, and then December really does. So from a seasonal perspective, looking at the S&P 500, yes, October, November, December all favor the bulls. Now you might be thinking, okay, cool, that's every single October, but what about an election October? The S&P 500 monthly performance during election years. So instead of looking at every single October, let's look at just the one when we're having an election. It's actually a small drop of about 0.3% has been the median return. So slightly favoring the bears, but really nothing to, I guess, get too freaked out about. Now let's actually look at it in a different way. Let's look at it in January to October, the full election year, and the year after the election, and we're going to look at it from 1944 all the way up to 2020. As you can see, the median return from January to October, where we are right now, 5.6%. If you look at the full election year, as in January to really January of the next year, 10.7% is the median return. And then for the year after the election, 9.8. Now, the thing I want to bring to your attention here is this is every election, as in the Democrats win, the Republicans win, highly contested elections, ones that were very obvious, everything. It still favors the bulls. So yes, you might be able to look for certain advantages in certain subsectors, as we just discussed with Trump, most likely more favorable for small cap. And then also we're going to have probably renewables like solar, biofuels, nuclear. That's probably going to be a little bit more beneficial with a Harris presidency. But when you're talking about the overall market, I want to make this explicitly clear. It pays to be a bull. It doesn't matter. Left, right, in the middle, it pays to be a bull. The other thing I want to bring to your attention is just because right now we know a lot of the influence is due to the Fed and with the rate cuts and what's going on with inflation, one of the most comparable time periods is from 1998 to 2001, very similar to what's going on right now, not only in the stock charts movement, but also just the monetary policy. Well, just looking at some comparisons here, 1998, once again, just to clarify, this is the monthly. We saw some nice pumps and we made it a decent chunk in. And then with the dot-com bubble kind of popping, that's when we saw it. So I'm of the mindset that in the medium term, we're going to take a hit at some point, probably somewhere in the year of 2025. But in the short term, the short to medium term, I actually think the bulls are still going to dominate. Now, for those of you who are maybe a little bit more interested in the world of crypto, I thought this was pretty interesting. 80% of Octobers were green for Bitcoin, just to be specific. 100% of election years have been green in October, November, and December. 100% of the years with green September had a green October, November, and December. September is green, and this is an election year. Hard not to be bullish. So if you're out there loving your cryptocurrency, the historic trend of the situation highly favors your current position. And then the last thing I want to just wrap this up is this really interesting video where you have a market expert kind of breaking down what they're seeing the current trend is in the world of options, not only in the US here, but also in China, because recently we've been all paying attention to the news of how China's rippity-skippity doo-dah to the upside because of all the government stimulus that they're now doing, not only in the stock market, but in the world of corporations and the buybacks, but also in the world of real estate. So right now, in real time, we're going to be able to see the breakdown of where people are buying basically their hedges. Are they hedging to the upside? Are they hedging to the downside? I thought this was actually very insightful.
For some insights on what the options might be saying about equities, volatility, let's bring in Amy Wu-Silverman, head of derivative strategy at RBC Capital Markets. And really people should watch all the time. The Royal Bank of Canada. Hopefully they were watching. You were on about a month ago. And at the time you pointed out that in previous rallies during the year, you didn't see hedging increase.
Right.
But a month ago you said the VIX was still quiet after that spike. But about a month ago you said you are starting to see quite a bit of hedging. And now it's continuing. Nothing's happened in the past month, though, that to indicate that all that angst
in
among
real
traders
time
was justified. You still think that something could happen because has it even increased the hedging?
It's even increased, Joe, and the way I think about it is the market is sort of lying awake at night and wondering what bad things could happen. I say that because that demand in hedging has not only picked up more, you see it in these secondary metrics that I appreciate most people don't watch all the time. We do. But not the VIX itself, but the volatility of the VIX has picked up.
The VVIX.
The VVIX, the vol of vol, has picked up substantially. Yeah, I know. It makes your brain hurt for a little bit. But look, it's the idea that these tails in the market, these kind of 3 standard deviation drawdown scenarios, we're very much seeing money being put into these. So obviously, we have earnings coming up. Obviously, we have U.S. elections, and the worry continues to rise. And that, again, is a very different narrative from the first 6 months of this year.
I think last time you were on, there were some straddles that were getting expensive. So is the hedging only on the downside, or is the hedging, it's only on the downside? You're not hedging against like a major melt-up?
No, not on the S&P 500. Now, that's not true for China. We're seeing all the upside hedging actually in the China-related ETFs. Obviously, Beijing had that stimulus come out, and investors are, really feeling that MOMO and FOMO there. All these ETFs that are related to China, so an FXI, ASHR, KWEB, EEM. These are all plays related to stimulus, and we've seen historic call buying there, but almost none related to the S&P. The bet there is much more for limited upside.
The October lows that we've hit so many times in the past usually come after a weak September, though. It almost seems too late for an extend itself unless it was really sharp. Do you think something like that is possible, like a real fast drawdown between now and the teens of the Ides of October?
Look, when you look back to the seasonal playbook, you would say the drawdown in October, the pickup in volatility is usually there. You go back 20 years, that's what we see, right? But again, like you said, that's after a weak September too. Now, how does that play into it? I think things are going to drag out a little bit because obviously Usually in November, we actually see the market do okay, but we have fairly large catalysts this time that we don't have all the time, right? We only have it every 4 years. And so I think that kind of shift things a bit later. And obviously earnings. Usually you get a tick up in volatility the first 2 weeks of earnings, because that's the first time you get all these kind of idiosyncratic pieces of news flow, and you get a tick up for volatility because of that too.
All right, so what does that all mean in layman's terms? As we're heading into this election, we're seeing two new trends. People are saying, hey, okay, we see limited upside in the S&P 500, as in we are like, if it goes up, cool, we just don't think it's going to go up that much. But we are seeing hedges in the volatility of volatility. As in the volatility of volatility, VVIX will be increasing. That's all going on in the US. And then in China, we're just seeing gigantic amounts of call buying, and that's just because of all the stimulus that we've been covering in so many of these videos. So putting this together with all the trends of what we've seen in elections, what we've seen in October, the short term, it's always very difficult to predict. I'm talking about the day-to-day movement because there's so much noise, there's so much randomness, so you always have to protect yourself. But I would argue in the short to medium term, the bulls are still going to be in control. Then in more of the medium to long term, that's when we're going to take a hit at some point, just because this is what happens when you have the steepening yield curve. And then in the long term, it just always pays to be a bull.